So this fella who initiated this webinar today, he said to me, I'm just kind of making up numbers here. I got $500,000 in my Roth. I have $2 million in my traditional IRA. He said, and I want to convert the rest of the traditional IRA to Roth. He said, but I'm not leaving any of it to my kids. They have enough. They've done well. I'm not leaving any of it to my kids. I'm done with them. Not in a negative way. He just said, they're good. I took care of them, or they've taken care of themselves. Not leaving any of it to my kids. And I said, well, where are you going to leave it? He says, I'm going to leave it to my church. And that's fine, whatever charity that is. And I said, well, you don't want to do another nickel. Again, you probably don't want to do another nickel of Roth conversions. Because he was talking about how to spend down his RMDs. And that's, he was being very strategic about these things. And that's all good. But I said, you may not want to do one more nickel of Roth conversions, because if you're going to leave everything to a charity, the charity's not going to pay tax on that, the $2 million IRA or whatever it grows to. If it grows to $1 billion, they're still not going to pay tax on that charitable organization under the current tax code. So why in the world would you convert $1 of it, pay 24% or 37 cents, whatever your tax rate is on that dollar, unnecessarily, when your heirs, being a charity, are never going to pay a nickel of tax? And he said, I didn't consider that. He also told me, though, that he was taking advantage of these things called QCDs, qualified charitable distributions. He said, well, geez, I've been sending them. My RMD is about $75,000. I've been sending them about $30,000 and living off the rest. And I said, well, you might want to consider, you can spend or send up to $105,000 each individual, for a year to a qualified charity directly. So if your goal is to leave money when you're no longer here to a charity, you may want to start during your lifetime. Send it right to the charity. You don't pay tax on that. And even if it wasn't, it doesn't have to be $105,000. It can be a portion of that. Maybe it can't be $105,000. Of course, you have to make sure your needs are taken care of first before you send anybody any money. Make sure that your needs are being taken care of. But it makes sense. It potentially makes sense for this individual to never convert again. Why wouldn't this individual, going back to our brackets, and let's just fill in the numbers here. If we've got $2 million sitting over here and they have $500,000 over here, why wouldn't they live off of this money for as long as they could? Or do a proper financial plan, draw their needs out of the tax deferred bucket, why taxes are still lower than they're likely to be in the future, pay a 20 to 24% marginal tax rate to cover their needs. He says he lives very modestly, so maybe it's not even that level. Maybe he's at a 10% tax rate just to cover his needs. And then when you hit that certain balance that makes sense, well, then start sending this money via QCD, or maybe you do it while you're drawing down for yourself as well, and then start living off of the Roth IRA. Because listen, if he's going to leave something, anything at all to the kids, it's much better to be here out of the Roth IRA. So I hope that makes sense. The first thing is charity. Pay attention to those beneficiary designations and where they go. And also, because you can do, like I said earlier in this, you don't have to have these complicated trusts in your IRA. And for a lot of trust as beneficiaries and IRAs, it doesn't make sense anymore. It was very popular to have trusts as beneficiaries prior to the Secure Act, but with the elimination of the stretch IRA for most people, except those eligible designated beneficiaries, most of these trusts don't make sense. So if you have a trust in your who is the beneficiary of your IRA, and you haven't reviewed it since in the past few years, since the Secure Act came out, then you must do that. You should have that reviewed, because that could be a level of complexity that makes 0 sense in your plan. So pay attention to those beneficiary designations. That's an area where it may not make sense to convert. You can take advantage of QCDs. If you're charitably inclined, you can send those funds directly to the charity. You have to be over 73 years old. There are rules around this. So again, use this as a guide, not as advice. This is education, not advice. but you may want to consider qualified charitable distributions. This is now adjusted for inflation, but it can be up to $105,000 per individual. You can't QCD for somebody else's RMD. But that's a consideration. That's where it may not make sense to convert. If you're going to leave money to charity, if you're not going to leave it to beneficiaries, who are people, and some people will say to me, "Well, geez, I've got $400,000 in my IRA, and I really want to convert this." Sometimes I say, "Well, it doesn't make sense." It doesn't make sense because you may not have to convert any of it, and you still can withdraw those funds tax-free. So if we just go back to our document here, our tax form, everybody has a standard deduction. So your standard deduction for a married filing joint is, if you're less than 65 years old, this is for 2024, is $29,200. If you're over age 65 or blind, and if you're over age 65 and blind, you get a little bit more, but you get another $1,550 each. Single filers, of course, yours is less, the standard deduction, and we want to pay attention to that. But remember what I said about this person. He said, I'm just going to come over here. He said, my RMD, can you see this? Yeah, my RMD is about $75,000 a year. So if he doesn't have any other income, and he doesn't, his Social Security and withdrawals from his IRAs, what if he drew this down just to a level where his required minimum distributions were offset by his standard deduction? Well, let's look at it another way. I mean, that's one strategy, but let's look at it another way. What if a person has $400,000 in this tax-deferred vehicle? Let's make a new one. $400,000 in this tax-deferred vehicle. And their first year RMD will be about, let's just call it $14,000 roughly. So that $14,000 from an RMD, if you don't have any other income, is $14,000 less than the standard deduction for a married filing joint couple of $29,200, even without the increase for the amount over 65. So we got to add 15. What was it? $1,550 each. $1,550 each to that. So is that $14,000 less than the $29,200? Just lost my calculator. $29,200, $32,300. Well, of course, the answer is yes. So this $14,000 is less than $32,300. So you still have room for other use of that standard deduction. If you are overzealous and say, hey, this is my tax deferred bucket, these are my IRAs, and I now read about Roth conversions, and I want to convert that money over here to Roth, and I talk to somebody and they have a schedule or I've put together my own schedule. I want to do $100,000 a year for the next 4 years. You might be really happy with that and think, okay, good. Now I've taken this down to zero, and now I'm going to have $400,000 plus growth over here, and I'll never pay tax again. Well, it could be that you never had to pay tax to begin with, because if you didn't have any other income, your $400,000 is going to generate a required minimum distribution that's below your standard deduction. You get to deduct. Your standard deduction means you get to deduct that income. So if you can deduct $32,000 off of $14,000 in income, you still have room. That means you pay zero tax on that $14,000. This is missed all the time. So now you might say, Mark, why don't we go more then? What if it's $800,000? Because a married filing joint couple, up to $32,500. Here's where I err on the side of being conservative and take this piece of education again. One of you is going to pass before the other. Once you pass away, your standard deduction, remember, let me erase this so we can see. Your standard deduction Cuts in half, basically. So you lose the extra $1,550, right? You go to $1,950. You get a little bit of an increase there, $400. But you go from $29,200 to $1,460. So now suddenly you can be in a position where you're paying tax. So you don't want to be overzealous about Roth conversions, because you may have an amount in your traditional IRA that's not worth converting anyway, not worth it, but from a tax point of view. Or you may have $1 million in this IRA, and someone advised you to take it all the way down to zero when you could leave $400,000. Maybe your number is $200,000. Let me say that I'm using $400,000 as an example. $400,000 is not your number. It's different for everybody. Your number might be $200,000. Your number might be $400,000. Your number that you could leave in your tax deferred bucket might be zero. If you have other income, if you have pensions, if you have rental income, if you have things like that, then your number might be zero. But you have to look at what that number is before you come up with your conversion strategy, because in fact, it may not make sense to convert if you can produce an RMD that is less than your standard deduction. But be careful. We want to pay attention to the married versus single, because if you're single, it's a little easier to do planning because you already have a single mindset. If you're married, I am always shocked at the number of people when I say, well, one of you is going to pass before the other, and they say, ooh, I didn't think about that. And that's a big impact. Your tax rate changes dramatically. You lose your standard deduction. Most of you are still living off of your standard deduction. You know, that's what you're claiming is your standard deduction. That's what I find. Most retirees, by the time they get to close to retirement, they've lost all their other deductions and they're dealing with their standard deduction. So there are times, folks, when it doesn't make sense to convert to a Roth IRA. You don't want to pay unnecessarily high tax. If you're charitably inclined, see if there's money if any of that money that you're going to leave to charity is IRA money. You do not want to convert that. You likely don't want to convert it because that charitable organization will never pay tax on that money. Why would you pay tax when the people you're going to leave it to are never going to pay tax? You can take advantage of beneficiary designations to get that money to the right place. You can take advantage of qualified charitable distributions to distribute that money during your lifetime. You don't have to wait until you pass. So there's a lot of ways to manage a tax efficient strategy if you're charitably inclined. If you're not charitably inclined, then that's not for you, and that's okay. Maybe it makes sense to do Roth conversions if you want to leave as much as you can to the kids or your heirs, and you don't want them to worry about tax, or whatever's left. Even if you say, I want to make sure our needs are taken care of, which this is how most people think, I want to make sure our needs are taken care of, and whatever's left passes as most efficiently as possible to my heirs. And most efficiently typically means time and tax. So beneficiary designations is the best use of time. Roth IRAs and life insurance policies are the best vehicles for tax. And the last thing, and there might be other reasons too. And if you're an expert, if you think of another reason why it may not make sense to convert to a Roth IRA, and I just thought of one, but the other might be that you can maintain a balance in your traditional. You may be able to maintain a balance in your traditional IRA that generates a required minimum distribution that is below your standard deduction. Therefore, you won't pay tax on that distribution, absent any other income, of course. And if you have pension income or real estate like rental income or other income, then that scheme won't work for you. But that is a time potentially when you would not convert if you can maintain that balance in your traditional IRA. The other one that I'm going to add here, let me go back to the screen, I just thought of it, is cash flow. You have to pay the tax. On a Roth conversion, you must pay the tax. If you don't have the assets to pay the tax, and if you're below 59.5 and you can't even do withholding to pay that tax, then that strategy may not work for you. So there are things, and if we talk longer, I may come up with a couple more, but there are times when it does not make sense to convert. How do you figure these things out? Folks, you work with a qualified financial planner, of course, not just any old financial advisor, not just any old stockbroker, and not just any old, even certified financial planner. This is a very specialized area I've been doing it since 2012. I've been focusing on this area. I've been doing this work since 2001. But everything changed for me in 2012 when I met a fellow named Ed Slott, attended one of his events, and it's been a wonderful experience since then. We have the opportunity to change people's lives by often producing more cash flow for them, more assets for themselves, for their heirs. The comfort of being tax efficient or tax free in retirement is really very exciting when you're just completely remove a future risk that most people are just going to wake up to one day and they're going to say, darn it, I wish I knew about this. I've never had someone who sat across the table from me or sat across the webcam on a Zoom meeting who said, geez, I wish I would have waited a little bit longer to do this. So take advantage today. Arm yourself with this education. If I don't know you and you want to schedule a 15-minute consultation, you can do so by contacting us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you're a dear client of ours, just reach out to us. You know how to reach us. You've got your own special emails and your own special access, and we'll see you as soon as possible. Nearly immediately. And if you have anything you'd like us to talk about in a webinar, send me an email also at questions@attleborowealth.com. That's questions@attleborowealth.com. I see a lot of comments flying in here. So after we're done here, I'm going to take a minute to read them, and I'll comment the best I can. Otherwise, folks, have a great rest of the week. We will see you next week. There's no holiday or anything. There's a holiday next week, but not until Thursday. So we'll see you next Wednesday. I look forward to it. Talk to you soon. Take care.